stop what you're doing. By 2026, gold and silver could become your most important financial hedge, and most people don't even own enough. With inflation, debt, and global uncertainty rising, missing out now could mean paying the price later. In the next few minutes, I'm going to show you exactly how much gold and silver you should own before it's too late, why it matters, and how to position yourself to protect your wealth, no matter what happens. Welcome to Silver News, your trusted source for gold, silver, and precious metals insights. From daily price updates to expert-backed investment strategies, we break down the bullion market so you can stay informed, protected, and ahead of the curve. Let's get started. The past few years have been eye-opening. Inflation has surged in ways many people didn't anticipate. Governments have printed unprecedented amounts of money, and interest rates have fluctuated wildly. Traditional financial systems are showing signs of stress. When paper currencies weaken, physical assets like gold and silver naturally rise in importance because they are tangible, universally recognized, and historically resilient. By 2026, the dynamics that make gold and silver essential could be stronger than ever, and being underexposed could mean missing a vital hedge against financial uncertainty. Let's talk numbers first. There isn't a single magic number of ounces that everyone should own. Because your personal financial situation, goals, and risk tolerance matter. That said, financial experts generally recommend that a portion of your portfolio, think of it as insurance, be allocated to precious metals. For wealth protection, a common range is between 5 and 15% of your total investable assets in gold, and 1 to 5% in silver. Why the difference? Gold is more stable and less volatile, making it the cornerstone of a safe haven strategy. Silver, on the other hand, is more volatile but has massive industrial demand. It can deliver bigger gains, but it can also swing sharply in value, so the allocation is naturally smaller. Imagine you have a $100,000 investable portfolio. Using the conservative wealth protection model, that would translate to $5,000, $15,000 in gold, and $1,000, $5,000 in silver. That might seem small, but it's enough to serve as a hedge against currency devaluation, market crashes, or other financial shocks. If you're aiming for a balanced strategy that combines protection with growth potential, increasing allocations to about 10 to 20% in gold and 5 to 10% in silver is reasonable. For $100,000, that's $10,000, $20,000 in gold, and $5,000, $10,000 in silver. This strategy is suitable if you believe inflationary pressures will continue, and if you want your metals holdings to contribute meaningfully to wealth preservation while still allowing some upside potential. For the more aggressive investor, someone who anticipates a major commodity rally or believes in systemic financial stress, higher allocations might make sense. That could mean 20 to 30% of your portfolio in gold and 10 to 20% in silver. Yes, these allocations are much higher, but they redesigned for individuals willing to tolerate volatility and the swings that come with precious metals. It's worth noting, however, that silver can be especially volatile, so timing and risk management are key. You don't want to overcommit in a market that can fluctuate dramatically over weeks or months. Physical versus paper holdings is another critical consideration. Physical gold and silver coins and bars offer true ownership, but they come with storage, insurance, and liquidity considerations. Paper holdings like ETFs or futures contracts are easier to buy and sell, but carry counterparty risk. Many experts suggest having at least a portion in physical form to truly hedge against systemic risks. If governments or banks fail to honor paper claims during a crisis, physical ownership ensures access to tangible wealth. It's also useful to translate these allocations into ounces, so you know what you're aiming for in practical terms. Assuming gold is around $2,400 per ounce and silver is about $40 per ounce, a $10,000 gold allocation buys roughly 4 ounces, while a $5,000 silver allocation buys about 125 ounces. These numbers are illustrative, but they give a sense of the tangible quantities you could hold. As prices fluctuate, so will the ounces you can acquire for your target investment, which is why regular monitoring and dollar-cost averaging are smart strategies. By 2026, industrial demand will continue to affect silver more than gold. Silver isn't just an investment. It's a critical component in solar panels, electronics, medical equipment, and emerging technologies like electric vehicles and AI infrastructure. That means its supply is under pressure, and shortages are possible if demand continues to grow while mining output remains relatively flat. Gold, on the other hand, is less consumed in industrial processes and more reserved for storage and investment, which contributes to its relative stability. Understanding this dynamic helps investors allocate appropriately between the two metals. Another factor to consider is the broader macroeconomic environment. Central banks are running massive deficits, interest payments on debt are climbing, and many economies are seeing weakening confidence in fiat currencies. As trust in paper money diminishes, tangible assets like gold and silver become increasingly attractive. Gold and silver are historically reliable hedges against fiat currency devaluation. If you're underexposed by 2026, you might find yourself facing a scenario where metals surge, while cash and traditional investments underperform. It is also worth mentioning that timing and gradual accumulation matter more than trying to buy the top or time the bottom. Regularly acquiring small amounts through dollar-cost averaging helps mitigate risk and reduces the stress of market volatility. Whether you're buying physical coins, bars, or ETFs, consistency is key. Rebalancing once a year ensures that metals remain within your target allocation without letting sudden price spikes or drops throw off your strategy. For most investors, a simple rule of thumb is effective. By 2026, aim for about 10% of your investable assets in gold and 5% in silver. This balance offers protection without overexposure to volatility, positions you to benefit from potential upside, and keeps your portfolio diversified. It is a strategy that works for both younger investors looking to hedge long-term and older investors seeking stability in retirement planning. Finally, remember that gold and silver should be considered long-term strategic assets, not cash substitutes. Keep them in secure storage, separate from your emergency funds, and use them primarily as a hedge or insurance. They aren't meant to be liquidated for everyday expenses unless an extraordinary situation arises. Gold and silver in 2026 won't just be investment opportunities. They will be measures of financial foresight. Allocating wisely now ensures you're prepared for a variety of scenarios, from inflationary pressures to geopolitical shocks. By understanding how much you need and why, you protect your wealth, maintain flexibility, and position yourself to take advantage of the inevitable market shifts that lie ahead. Timing, allocation, and consistency are everything, and with the right strategy, your gold and silver holdings could make the difference between preserving your wealth and seeing it eroded in an increasingly uncertain world. Thanks for watching Silver News. If you found value, hit the like button, subscribe, and turn on notifications. Stay informed, stay invested, and we'll see you in the next update on gold, silver, and the bullion markets.